Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly, will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. And now, here's Bill Bullington.
Hey, welcome back. This is Bill Bullington, here every Saturday morning from 11 to noon. Having a few technical difficulties today. There seem to be a lot of those lately. Not just lately. I think it's during the whole pandemic when they started sending people home and not full staffs all over the country. So I guess we've been affected by that as well as the other firms. But I'm here now, so that's all that really matters. If you'd like to call in today, the number is 216-901-0945. And again, that number is 216-901-0945. And I'm going to be talking today about a few things that I had sent out in the a newsletter that you can sign up for. It's free, and nobody's going to call you if you sign up for it to try to sell you anything. But it's a newsletter that I put out in conjunction with a company who has the publishing rights to several thousand major publications like the Wall Street Journal, Barron's, London Times, Forbes. There's tons of them. So I really like the service. I edit the newsletter before I send it out, and so I get to pick which articles I'm actually going to send and what that message is going to be, and it's fun. So today I think it's really important to try to work on your psychological or your mindset, basically, how you see things, how you handle a lot of the stuff that has, quite frankly, never happened before, and it's kind of interesting. Yeah, I've always said in my entire career, I guess after I got a good 4 or 5 years of full-time experience, I realized that when people say it's different this time, that they're actually right. It's always different. It's never the same exact way over again. It doesn't actually repeat the way it did before, but there will be a lot of similarity to some certain things that are happening. Anyway, in the newsletter that I sent out, I'll just go through it with you. So if you've missed it, you can hear it here. If you would like a copy of this, again, just go to my website, and on the contact us form, you can fill it in. Anyway, Living in these uncertain times may fill you with frequent questions about the state of your finances, and wellness, seemingly by the minute, depending on the news of the day. Well, that's what the news, by the way, would like you to think. Nothing is ever, well, very rarely is something that you have to happening that you have to react to immediately. The vast majority of the time, it's too late by the time it makes it to the media anyway. But so, article goes on to say, thankfully this week, calm has settled over financial markets after the banking industry's recent volatility. Is this a positive sign for the coming months, or could there be something deeper happening? That's why I'm passing along these articles this week that can help answer some of the pressing questions you may be pondering, such as, what's this all I hear about a recession? Should I just be putting my cash under a mattress right now? Can I buy a house or a Tesla? Asking questions about financial matters is crucial for making informed decisions and achieving your financial goals. You know what? That's I left that line in there, even though those are lines I always complain about, because hardly anything is actually super crucial. It's more like layers of decisions that you make that end up being good or bad, and it's not like everything hinges on one tiny little detail. But anyway, financial literacy is a skill that everyone should strive to develop, and what better time to focus on financial literacy than April, which is Financial Literacy Month in America, probably because this is when your taxes are due or your tax return. If you're like me, I'm on the permanent extension program. It's I don't even start trying to, it costs me money every year, by the way. I wouldn't recommend this for everyone. But I don't start gathering my stuff up until June. That's about the time that it starts to get warm. And our business slows down a lot summertime. So if you are looking for a career, young people, and you want to be financial advisors and you'd like to have a lot more free time during the summer, I would tell you that, this is probably a pretty good industry. Most people are on vacation, and it doesn't really get busy again until the beginning of September, and then that'll run all the way through, right up through about now and the beginning of May. Those are our busy times. So just in case you ever wondered or were curious. Anyway, please enjoy the articles, and let's build your financial acumen. What are you curious about? I'd love to have any questions. So if you signed up for this, or if you already get this and you have questions on these articles, please feel free to reach out and let me try to help you with that. I'll do the best that I can. And it's really fascinating. Some of the articles, if you're risk averse, this is one I liked. If you're risk averse, what could you be missing? Whatever you can do or dream you can, begin it. Boldness has genius, power, and magic in it. Would you guess who said that? Great. Doesn't even say. That is hilarious. No, actually it does say it was Johann Wolfgang von Goethe, an 18th century German poet, playwright, scientist, and statesman. Today he'd be called a thought leader. Risk-taking has had proponents from many walks of life. Security is mostly a superstition, said Helen Keller. Life is either a daring adventure or nothing. That's interesting. That sounds a lot like the stock market. T.S. Eliot said that only those who will risk going too far can possibly find out how far it is possible to go. Daredevil circus performer Carl Walenda said, life is being on the wire. Everything else is just waiting. Racing driver Mario Andretti said, if things seem under control, you're just not going fast enough. As for Jimmy Carter's view on risk-taking, it's pleasantly simple. Go out on a limb, that's where the fruit is. So what is it that causes most people to be risk-averse? Dr. Suzette Boone, a specialist in diagnosis and treatment of complex physiological disorders, say fear and anxiety cause people to lean heavily on caution when making decisions. But fear and failure are not the same thing. Fear kills more dreams than failure ever will. Some of our fears are irrational. For example, the odds of being attacked by a shark are 1 in 3.75 million. Your odds of dying in a car crash are only 1 in 103. Wow, slightly less than 1%. But you're likely more afraid of sharks than of automobiles. Yes, because you can visualize the shark. Anyway, Angie Morgan-Wachowski has a lot of smart things to say on this subject. With her colleague Courtney Lynch, she's the author of Bet on You, How to Win with Risk. Wachowski and Lynch met in the Marine Corps. Today they apply their leadership lessons in their consultancy, Lead Star. Both of their previous books, Spark and Leading from the Front, were New York Times bestsellers. In approaching important choices and decisions, a lot of people are so risk-averse that they miss valuable opportunities. So we might ask, what's behind that aversion? By the way, something I would like to add here, it's not just that they miss certain opportunities. There's a fear of missing out that creeps in after they realize that they miss an opportunity, and then they come into something when it's too late, and oftentimes that gets them hurt. So like to throw my 2 cents in there. Anyway, article goes on to, there's a war going on in our minds when we're faced with big decisions. The war is between a promotion and prevention mindset. One is telling us to play to win. The other is telling us to play not to lose. That mindset might sound nuanced, but we've all experienced specific times when our aim was to keep our heads down, do the work, and achieve the goal while avoiding any large choices that could disrupt the good thing we've got going for ourselves. A lot of athletes would actually relate to a lot of this. That's one of the reasons I think kids, if you want to do something for your kids or grandkids, buy them that pair of soccer cleats. Get them in sport because they learn to face fears, overcome challenges at a really young age. I think it helps a lot as they get older. Anyway, the article goes on to say our relationship with risk, she says, is a learned process. If we're not happy with how we perceive risk and risk-taking, we can change. I will tell you, change is not easy. Is it possible? Yep. What does she see as the steps to reimagining risk? The concept of risk is often presented to us as if it's the downside or negative consequences of a choice. In reality, risk is just really a decision that leads you into uncertainty. If you think about it, we're always taking risks. Getting married, going to college, having children, all massively huge risks. What's different about the risks we want to take now is that they're more of an expression of our unique preferences and experiences, so less endorsed by society and approved by your mom, which makes them more intimidating, or at least more intimidating than they need to be. To reimagine risk, Wachowski says, it's important to overcome 3 misconceptions. Risk is the opposite of reward, is the first misconception. Anything good in your life was the result of risk. Risk isn't the opposite of reward. It's the path to reward. Second point, risk is a leap. Risk done wrong is a big leap, like quit your job, change your life. Now, that could be could go both ways. Anyway, responsible risk-taking requires thoughtful planning and preparation. And that, that is so pertinent to what it's like to manage portfolios. Most people think managing risk is avoiding risk. That's not managing it. You're avoiding it. And I agree with this wholeheartedly. You should think out how much risk you're willing to take. And that's where when I'm doing an interview with a client, a potential client, the first thing we want to look at are the risks that they're accepting, and which risks can you avoid and which risks can you not avoid. And the ones you can't avoid, you're going to have to learn how to manage. If you can't avoid it, you can manage it. I'll just give an example. Let's say I'd like to get highest returns. I'm going to shoot for a return that's over 10% a year. If you're going to shoot for over 10% a year, first of all, I'm going to tell you that very, very, very few investors ever manage that in the long run, especially when you consider that there are years where the people that have done that have been down significantly, 30, 40, 50%. Warren Buffett's been down 50% multiple times in his lifetime, multiple times. So that's where they're confusing being able to avoid risk and managing the risk. You can't avoid declines in markets, but you can manage it. How do you do that? Well, let's say you've got a good stock portfolio, but you don't want to see your assets cut in half. So you take some of the money and you invest it in something that's safer. You can use annuities, you can use CDs, you can use treasury bonds, high-quality corporate bonds, funds that invest in high-quality corporate bonds. There are lots of ways to reduce that risk. And if you talk with your advisor or do enough research on your own, you might be able to figure it out. But that's kind of what an advisor does, is take a look at how much risk that you're willing to take. And now let's put a portfolio together that's realistic, that is going to keep you within those guidelines. And the guidelines are, all right, I think I can take. So my risk tolerance, that's how I do it. My risk tolerance is about 40%. I figure, I can take a 40% decline. I wouldn't be happy about it. But if my investments were down 40%, I would not be panicking. So, and I fully expect that at some point in time, I'll be down at least 40%. If I live long enough, I'm sure of it. Yeah, well, why would you do that, Bill? Yeah, well, because I'm looking for higher than average return. So if I'm going to look for higher than average returns, I'm probably going to have to be willing to put up with a lot of risk. And that number is that I came up with is really a good number or a good method. If I am hearing myself in the background, if I'm willing to take a 25% decline, for example, and I know that if you were in the stock market and you were part of the 99.9% of the people who invest in markets who cannot accurately predict what the market's going to do in advance, at 99.9% of us, then I've got to be prepared to handle that risk and manage that risk. So I got about 20 seconds before I have to take a real quick commercial break. And we're going to pick up on this topic when we come back from the commercial break. And I'll just take this time to tell you this is Bill Bullington again. If you like what you hear, you can go to my website. I can send you a copy of this article. We'll as soon as we come back from the commercial messages, we'll pick back up. And I'm going to take a real quick break right now. Stay tuned. Talk to you soon.
Is this really the life I'm living? 'Cause I don't feel like I deserve it. Every day that I wake, every breath that I take. I saw mercy. Mercy seated where the judge should be was guilty.
And we're back. Hey, this is Bill Bullington. I'm here every Saturday morning from 11 to noon. I was just reading a little bit from one of the articles that I sent out in this week's newsletter. And if you'd like to talk about your personal situation, if you'd like to be on that newsletter mailing list, no pesky salespeople will call, I promise you that. But we like to work with people who like to work with us, and we are not a low-pressure firm. We are a no-pressure firm. Life is hard enough. You don't need to be me making it harder. So anyway, I really liked this one article. And this is one of the first articles that went out this week. So if you haven't gotten it, then just hit me up on an email, and I will get it back out to you as quickly as I possibly can. And I think I started off or left off at this area where the article goes on to say risk-taking has proponents from many walks of life. Security is mostly a superstition, said Helen Keller. And it's pretty wild that she would have that observation. Life is either a daring adventure or nothing. T.S. Eliot said only those who will risk going too far can possibly find out how far it is possible to go. daredevil circus performer Carl Wallenda. The guy writing this must be pretty old. I remember a lot of these people, but I was pretty young when they were older. Anyway, Carl Wallenda. Wallendas were the Flying Wallendas. They were a circus act. They did high wire and all kinds of stuff. Very popular for a very long time period. And his comment was, life is being on the wire. He was talking about walking a tightrope. Everything else is just waiting. Racing car driver Mario Andretti said, if things seem under control, you're just not going fast enough. That's pretty funny. Jimmy Carter's view on risk-taking is pleasantly simple. Go out on a limb, that's where the fruit is. Anyway, so what is it that causes many people to be risk-averse? Dr. Suzette Boone, a specialist in the diagnosis and treatment of complex psychological disorders, says fear and anxiety cause people to lean heavily on caution when making decisions. But fear and failure are not the same thing. Fear kills more dreams than failure ever will. Some of our fears are irrational. For example, I think I just covered this as a little. That's okay. I'll just do it again anyway. For example, the odds of being attacked by a shark are 1 in 3.75 million. Your odds of dying in a car crash are about 1 in 103. But you're likely to be more afraid of sharks than automobiles. That's pretty funny. Very true. In approaching important choices and decisions, a lot of people are so risk-averse that they miss valuable opportunities. And I wanted to stop and talk about that right here, right now. I'll have people that claim to be very conservative, and they are. They're actually conservative. But they don't understand. They think conservative means being able to see something happening in the stock market ahead of time and getting out, waiting until the market goes down quite a bit, then bottoms, and then they're going to get back in. And they don't understand. That is the very definition of market timing. Let me say that again. That is the very definition of market timing. Trying to think that you can see when the market's going to stop going up or start going down, and then trying to see when it's going to start going back up again. And I can't tell you how many times I've had this conversation with people. Oh, I'm not trying to time the market. I just want to be out of harm's way when it starts to go down, and I want to be back in and participate in the upside. That is the definition. So I'm not arguing about that. I'm just telling you that's the way it is. And everybody I've ever seen that's ever tried to do that ends up with really bad returns. And it's one of the jobs as an advisor is to, first of all, expose you to that. Everybody that comes into my office for a meeting, which is free, by the way, if you want to come in and talk about your situation, it's free. There's no cost. Nobody's going to haunt you. But I will show you what it is I'm talking about here. I'm looking at the chart right now, and this is the S&P 500. These are the biggest 500 companies in the United States, not the whole stock market. But the other stocks have a tendency to drop even a little bit further than these. So here I'm looking at the emerging market, which in 2007, and I know everybody's saying, well, it's emerging markets. They're supposed to be more aggressive. Yeah, but you should have seen how much they were going up in the early 2000s. It was crazy. And then they had a big decline 2008, 2009. It started in 2007, same way that our market did. It was down 67%. It still has not recovered. If I look at the Dow Jones Industrial Average, 1999, it had let me see here, 38% decline, which was lasted over 3 years. It was going down for 3 years, and it finally bottoms out close to 40%. And it finally gets above where it was in the year 2000, and that's in 2006. It goes up in 2007, peaks in 2007, comes down by March of 2009. It's down 54%. So it's actually significantly below where it was 12 years before that time period. And see, that's what I'm talking about. They cannot pick those time periods. It's just too hard to do. But what you can do is limit your exposure and then rebalance your portfolio when nobody wants to rebalance it. And I'll give you a really quick example. Let's say you're 60% stock, 40% bonds, which are going to do much better in the next 10 and 15 years than they did in the last 10 to 15 years, only because interest rates are higher and you can get much better returns on the fixed income portion than you've been able to get in the last 10 years. So that's a big deal. And we'll talk a little bit more about that in a few minutes. But the bottom line is thinking that you're going to magically somehow jump in and jump out, bad idea. The better idea is to really give it a lot of thought. How much risk am I really willing to take? Am I willing to see my portfolio to be down by 10%, 20%, 30%? Now, I'm going to tell you this, young people. If you think you're going to have an average annual return of somewhere between 9 and 10% a year over the next 20 to 40 years, you're going to have to be almost exclusively in stocks. If history is any gauge, you're going to have to be 90 to 100% in stocks, which means if you were 90 to 100% in stocks over the last 40 years, you would have been down more than 50% multiple times. And I don't care what, it's easy to show a graph of the past that shows, yes, well, I would have gotten out here and I would have gotten back in here. Yeah, really? It's like looking at the answers to a test after the test is over, but you had to take the test before you had the answers. And the chances of you guessing correctly at all those answers probably wrong. And it's the same thing with the stock market. It just have to be there, and you got to give it some time. You need to know when the right times to make adjustments are, when there are good times, when there are bad times, when opportunities present themselves. If you were looking at what was going on over the past few years, 2008, 2009, the best thing to do during that time period was to already be expecting the big decline, have your portfolio built so that it was, you knew you were going to have a decline at some point in time, you just didn't know when. And if you were, by the way, the funds today, the ones that we use, are run by computers. They call them exchange-traded funds, and they're making adjustments every day. The nice thing about today is that with that type of a fund, you don't have to worry about having to pay taxes on those adjustments until you actually sell the fund. That's a big, big deal, and it makes managing money a lot easier from a tax standpoint. So it should help out an awful lot of people there. Now, you still have the risk. Okay? So if your funds were down quite a bit, yeah, in fact, I think, for the people that I'd already had conversations with this on, we swapped some of the funds that we had for funds that were similar, super similar. They're almost identical. It was just another company that put the fund out there. You've got multiple companies that put out ETFs, and some of them you can find that are actually identical. So if you're holding one and it's identical to another ETF, you can actually swap the one for the other, and you get to write off, potential write-off. It depends on how long you've been holding the fund. If you haven't been holding it that long, then there's no opportunity, or you might as well just stay still. But it's nice to have options. If you had an identical fund and it was down quite a bit, you could swap one for the other. And it's because it's a fund that's run by a different company, you'd actually be able to get to write off those losses if you had them. But you're still invested. That's a big deal. That protects the gains whenever you come back. So kind of interesting. It's kind of fun to think about, and especially when I see all the things that are going on in the economy now. The economy's growing fast. But if we didn't have a pandemic, there's no telling how big the economies worldwide would be. And if we didn't have a war going on in Europe, slowing things down, there's no telling. And a couple things I can tell you for sure, that the pandemic at some point in time is going to be managed the same way every other infectious disease has been managed. We're getting better at it. It's going to have less and less impact. And at some point in time, there's not going to be a war there anymore, and the future is pretty bright. There are an awful lot of projects that were put on hold because of all this stuff. And to me, it's just amazing that all of these things are going wrong at the same time. And I can't believe the market's not down significantly more than it is. I mean, it's just unbelievably resilient. And I guess people are getting better. Maybe shows like these, newsletters like the one I subscribed, or like the ones I subscribe to, probably helping a little bit. I think having tools to be able to come in, analyze what you're holding, and go, oh, okay, everything's okay. And that's a big deal. Take a look at what you're holding. Take a look at some of the names that are in the funds that you have. It's very reassuring because Procter & Gamble is not going out of business anytime soon unless people quit putting diapers on their babies and washing their clothes. Highly doubt either one of those things is going to happen. So anyway, I'm going to get back to the article real quick. In approaching important choices and decisions, a lot of people are so risk-averse that they miss valuable opportunities. Yep. So we might ask, what's behind that aversion? There's a war going on in our minds when we're faced with big decisions. The war is between a promotion and a prevention mindset. One is telling us to play to win. By the way, I realize that I'm rereading this, but I just feel like it's really important that you hear this. A part of your mind is telling you to play to win. The other part is telling you to play not to lose. Now, that might sound nuanced, but we've all experienced specific times when our aim was to keep our heads down, do the work, and achieve the goal while avoiding any large choices that could disrupt the good thing we've got going for ourselves. Our relationship with risk, she says, is a learned process. If we're not happy with how we perceive risk and risk-taking, we can change. And I'm going to tell you that change is not easy. And most people are not even aware of what kind of risk-taker they are. So when you come into my office or wherever we meet, okay, I'll show you a graph of the average mutual fund. I'll show you a graph of the average balance fund. And I'm going to show you that the reason I'm showing you those is so that I can point out how far they've gone down. When you look at the last 10 years, everything looks wonderful. I mean, it's like, wow, But if you've had money invested for more than 10 years, and actually, the last 10 years have been pretty volatile, but we haven't had the really big correction that took multiple years just to get back to break even. The last one of those was it ended in March 2009, and it started in November of 2007. For international emerging market and small and mid-cap stocks, it actually started much earlier in the year, in 2007. That's another thing that kind of drives me nuts about the industry. They talk about the annualized risk. Okay, annual means yearly. Okay. Whoever told anybody that a market cycle is going to begin and end in a single year? I mean, and I know they're not saying that, and that's what their response is going to be. Well, that's not what we said. We know what you said. I know what you said. But you knew that the public was going to perceive that a different way than the way that you said it. And that's how you avoid big lawsuits, by the way. But the reality is market cycles don't begin and end in 1 year. Some of them are multiple years. Some of them are decades. And that's the stuff that's really hard, is how do you predict that? How do you put together an income plan where you know you're going to have to take money out of those assets and they're going to be fluctuating all over the place? Well, that's where I come in. We'll come in and we're going to assume that the market's going to be the same market it's been my entire lifetime and my parents and my grandparents' lifetime. And then we're going to build our plans around that. We're going to take into account that there's going to be a lot of volatility. There are multiple things that you can do to kind of reduce that volatility to make it livable. And since I've only got about 15 or 20 seconds before I have to go to commercial break, I guess I'll have to say we'll talk about that when we come back from these commercial messages. And you're listening to Bill Bullington right here on 1420. Stay tuned because I will be right back.
Come set your rule and reign in our hearts again. Increase in us, we pray. Unveil why we're made. Come set our hearts ablaze with hope like wildfire.
Well, welcome back. This is Bill Bullington. I'm here every Saturday morning from 11 to noon. You can go to my website. If you hear something that you'd like more information on, there's a contact us page there. Just fill it out and put your question in there, and I'll get you on my newsletter mailing list if you'd like. It's not necessary, but if you have a question, please feel free to reach out to me. If you'd like to set up a personal meeting to talk about your own situation, we can do it on the phone, in person. You can do computer meetings, however you want to do it, and which is really cool. I'm getting ready. I've been prepared. I've been looking for years, actually, for the right service, and I've used quite a few of them. I think I'm really close to getting one that I'm going to be talking a little bit more about on future shows. But we're always working to try to improve the service that we have, keeping up with new ideas. Speaking of new ideas, there were some products that were around quite a while ago, and I didn't really like them a lot. They were too restrictive. The guaranteed returns were too low. They sold themselves based on the idea that you could make as much money as you might make in the stock market, but you wouldn't have any downside risk. Well, that wasn't true. The way it was promoted was actually legally correct, but the way that it was being interpreted by the general public was not correct. So I don't know who's to blame there. I don't really care. But there's a lot of confusion as a result of the marketing of fixed indexed annuity products. And I like the ones that are as simple as possible. And the reason I bring it up is because I think it makes with current interest rates, I think it's a really good idea. Let's say, and here I've got an example. Instead of going through the technical details, I don't want to do that. I mean, I'll be glad to do that with you if you want to go, if you want to set up a phone call. But if you just want this website, email me and I'll email you the link to the website. You can play around with this software yourself. It's put up by Nationwide, and the website allows you to put in your name and a dollar amount, and it'll tell you what kind of income you could generate from that. And so I put up a 66-year-old who's going to be 67 next year, and that's when their full, retirement age is with Social Security, at least now. By the way, if they put that off by 2 years, do you know that Social Security will be running at a slight surplus? Yeah, so I'm just hoping they don't do that. But because I can just hear my clients now, that would be rough on a lot of people. But the bottom line is, when they start talking about all these problems, and the reason that you hear so much about Social Security being so hard is that it's probably going to happen at some point in time. And you got to remember, when they started Social Security, I think I'll have to go back and look, but the age that you had to be to qualify for Social Security was also the average life expectancy. So you were expected to be dead by the time you were allowed to start collecting from your Social Security when they first started it, and they really didn't expect to have to pay out that much. But as people's life expectancy started getting longer and longer, and they were making more and more money, that is one of the reasons that we have a deficit. But one of the other reasons is that they keep borrowing. They were borrowing. They weren't supposed to be allowed to do that. That was supposed to be against the law, but they found ways to change the law to borrow from the Social Security Trust Fund. So a lot of the money that was supposed to be there for Social Security was going to fund other government projects. Lovely. Anyway, you want to supplement that Social Security. Let's say you're 66 next year. You're going to retire. For every $100,000 that you put into this product, your guaranteed lifetime income today would be $7,154. Okay, as a percentage of $100,000, that's 7.15. But you had to wait 12 months before you were able to take it. So it's not to say its yield is 7.15. No, that's a current yield. That's not the way it works. You got to go in 12 months in advance, and then you can turn that on, and it'll give you $7,154. Let's say you didn't want to do that. You don't want to retire at 67. You're going to go to the full retirement age of 70. That $100,000 that you put in would, at age 70, would pay you $9,257. Pretty good. That's really good. Now, it stays, whenever you turn it on, that's what it's going to stay at, and they're going to guarantee that will pay you that amount for the rest of your life, no matter how long you live. And I'm telling you, from what I've seen over the past 30 or 40 years, and the reason I started taking a really good, hard look at these products is I saw how poorly people were doing in their stock accounts because they panic. And it's okay. You're human. I get it. Yeah, but when they see something, they panic. They pull out of the market, and they try to jump back in the market, and they don't understand how difficult it is, and that even if they got it right one time, you have to do that consistently to be able to avoid that, and no one has ever been able to do that. Warren Buffett, one of the world's wealthiest individuals, has never tried to do that. Actually, I take it back. He sold some puts. That's a different thing altogether. He sold some puts, naked puts, very aggressive. I think he took $1 billion, and he took a huge loss. It was the 2007 through 2009 thing. He thought, well, the market can't possibly go lower than this. And a put is like an insurance policy for one, and the other side is the speculator. So the speculator takes one side of the trade, and the person that's seeking insurance is on the other side of the trade. And so he decided to speculate. Thought, well, the market can't go down much more than this. I think I'm going to put $1 billion in here, and if the market goes up, I actually sold for $1 billion. I sold it for $1 billion, the right for someone to sell me the whole stock market at this particular price. And they're futures contracts, by the way. Anyway, long story short, it ended up costing him a lot of money. I mean, he lost more than he had gambled for. So, and that rarely happens. That should just give you some idea of how difficult this is. With all that guy's experience and how much success he's had over his entire lifetime. And incidentally, his biggest income comes from insurance companies who manage risk for a living. So if he's going to get his butt handed to him like that, yeah, what are your chances? I mean, come on. What are your chances, really? So the bottom line, that's one of the reasons that I like these products. If you didn't have to take the income, let's say you didn't want to start at full Social Security age, you're going to put it off. And you're going to put off Social Security. You're going to work until you're 70. So at 70, your Social Security goes up about 8% a year from 67 to 70, the amount that you would get, actually. And so this one's actually going up a little bit faster than that. So the $100,000 that you put in there when you were 66, by the time you're 70, they'll guarantee you $9,257 a month, or a year rather, for the $100,000 for as long as you live. That's really good. And again, my point is that the vast majority of people don't earn that much in their stock account. Okay? And this is a guaranteed structure. Of course, it's only guaranteed by the insurance company. It's nationwide, which is they're A-plus rated. There's a fund in the state of Ohio that they can fall back on if they run into really big financial difficulties. It's not like the federal government. It's not like the FDIC, which has been having to pay out some really big claims here lately. But it's a really good, it's very, very good. It's extremely competitive. And if you'd like more information on that, I would be much more than happy to work with you and see if it might be something that would be good for your situation. And that's really, when you're talking about financial planning and advising, that's really how I like to approach things. Just show me what my options are. Take a look at my personal situation, see how much income I can generate from my investment, or how much I've saved towards retirement. What kind of income might I get from Social Security, a pension, maybe I've got some annuities out there that I could turn on to increase my income, and just take it from there. Very plain. I have a tendency not to hold back a lot. I'm never mean. As I'm never pushy. Yeah, but there are situations, and I've had a ton of clients come in, which I think is kind of funny. I didn't realize I was going to have to be a marriage counselor when I got my securities license. But oftentimes, one spouse will bring the other spouse in because the other spouse doesn't really know this stuff and has never heard about the 4% rule, and so I get to be the one to break the news, and I think it's kind of funny. It's a great career, but it does have little rough spots when somebody comes in and unrealistic expectations, I guess. And I have to be the one to break it to them. And it's normally one of the spouses, either the husband or the wife, that drags the other one in and says, okay, I've been telling them this, but now it's your turn. It's kind of funny. Kind of stressful when you're young, by the way. I've been through it so many times now that it's just water off the duck's back. So anyway, I thought this is a really nice option to be able to have for a portion of your retirement savings, because again, the average fund investor hasn't come anywhere close to the returns that they will guarantee on a contract like this. If you were an above average investor, I mean really above average, yeah, you could potentially do better, but you're going to have to be in the top 10% of all professional investors to be able to. That's my current opinion. I watch the market go up for 20% a year for the next 5 years, like it did in the late 90s, right before it crashed again. So the bottom line is this helps prevent against living too long, because the income will not run out before you do. And so big deal. I got about 25 seconds here before I have to sign off for today. If you heard anything you'd like more information on, just go to my website. It's bullingtoncapital.com. Fill out a contact us page there. I will try to get back to you as quickly as I possibly can. I appreciate everybody listening this morning. I hope everybody does well in their investments. And again, just give me a call. I hear the music. That means the show is definitely over. Have a good weekend, everybody. Good luck. Good investing.
Just caught another edition of the Bullington Capital Report, broadcasting every Saturday at 11 a.m. on AM 1420, The Answer. If you have a question and you'd like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or online at bullingtoncapital.com. That's bullingtoncapital.com.
The preceding program has been paid for by Bullington Capital Management, LLC.